Let's take a look at the international money market. Now, if you've studied money markets in the U.S., you know money markets are for short-term securities that mature in a year or less. So the euro currency is a time deposit in an international bank located in a country different than the country that issued the currency. So, for example, Eurodollars are US dollar denominated time deposits in banks located abroad. You can also have Euro yen, which are yen denominated time deposits in banks located outside of Japan. And we should note that the foreign bank doesn't have to be located in Europe. So, during the time period when the U.S. had restrictions on how much interest could be paid on bank deposits, wealthy investors or businesses would go into the Eurodollar market. So they're U.S. dollar denominated, they don't have to worry about exchange rate risk, but because these banks outside the U.S. were not restricted on how much interest they could pay, oftentimes the investor would receive quite a bit more. Eurocurrency. Most Eurocurrency transactions are interbank transactions in the amount of $1 million and up. So the common reference rates are LIBOR, which is the most popular one. You hear about LIBOR all the time, the London Interbank Offered Rate. There's also PIBOR, which is Paris Interbank Offered Rate, and SIBOR, the Singapore Interbank Offered Rate. But LIBOR is the one you always hear about. Now, there's a new reference rate for the new euro currency, the Euribor, I guess you would say, which is the rate at which interbank time deposits of euros are offered by one prime bank to another. Eurocredits. Eurocredits are short to medium-term loans of euro currency. The loans are denominated in currencies other than the home currency of the euro bank. So often the loans are too large for one bank to underwrite, so a number of banks form a syndicate to share the risk of the loan. Eurocredits feature an adjustable rate. On Eurocredits originating in London, the base rate is LIBOR. Again, what we mentioned before, the London Interbank Offered Rate. Euronotes. Euronotes are short-term notes underwritten by a group of international investment banks or international commercial banks. And they're sold at a discount from face value and pay back the full face value at maturity, typically with 3 to 6 month maturities. So you don't receive an interest payment or a coupon. What you do is you pay less money and you get the full face value when it matures, and that difference is the interest you receive. So much in the same way treasury bills are sold on a discount basis. Eurocommercial Paper. These are unsecured short-term promissory notes issued by corporations and banks, and they're placed directly with the public through a dealer. Maturity is usually from 1 to 6 months, and it turns out that Eurocommercial Paper typically, even though it's U.S. dollar denominated, oftentimes, is often of lower quality than U.S. commercial paper. So, as a result, yields are higher. And finally, let me just mention Eurodollar interest rate futures contracts. These are widely used futures contracts for hedging short-term U.S. dollar interest rate risk. In another video you can find that I've made, you can find me showing you how you do a hedge using a Eurodollar contract. The underlying asset is a hypothetical $1 million 90-day Eurodollar deposit, and the contract is cash settled. And these are traded on the Chicago Mercantile Exchange and the Singapore International Monetary Exchange. And these contracts trade in the months of March, June, September, and December. So those are the expiration date cycles.